How you doing, ladies and gentlemen? Welcome to This and That. I am your host, Xander, where we're talking about this, that, and everything in between. And I got to tell you, I greatly appreciate you guys coming to the show tonight. We are in a really unorthodox time. Make sure that you guys like and subscribe, join the membership. It is beneficial for you. For those of you who have not had the opportunity to catch us, we are live normally 7 days a week. We are definitely going to be 7 days a week, but we are normally at around uh, 10 Eastern, 9 Central, 6 Pacific. Today we're starting at an unorthodox hour, but just note, we're trying to balance the internet situation alongside some of the other setups of the show. As you can see, we got us a new theme song. We got another one that we're going to be putting up for tomorrow, so you'll be able to see a new intro, new exit for the show. So definitely make sure that you keep your eyes open for that. Today we're going to be talking about what is that? Oh, we are supposed to be talking about getting yourself the I or at least that's what we're supposed to be talking about today. We're supposed to be talking about the ideal dream portfolio, if I remember correctly, is what we were supposed to be dealing with today. Yes. And that's one of the reasons why we wanted to really wait until we got the internet up and going so that we didn't have any defects today. So you guys are going to enjoy today's show. I'm more than positive. Oh, I grabbed the wrong show. So actually, this show is supposed to be about driving your man away. Well, today we're actually going to be talking about the one we should have been talking about, which is building your dream investment portfolio. And then we're going to just change all the information over after the show. So sorry about that. I grabbed the wrong one. It happens because I got a lot of them up here. Either way, let's go ahead and run what was supposed to be today's show. And then we're just going to move some things around so that we can have that's going to be a lot of effort to edit. Either way, let's go ahead and stick with the originally scheduled program for yesterday, and then we're going to fix this for today. So today we're supposed to be, or last night we were supposed to be talking about the challenges of building a dream investment portfolio, starting from scratch going into 2025. So while we're trying to talk about building these investment portfolios, one of the important steps we were going to take away from achieving that is the financial security that we were looking for going into 2025 with all of the massive changes. So with the right portfolio, you can generate passive income and grow your wealth over time and achieve your long-term financial goals. Real quick, short story. I was just talking to one of my students right before the show. One of the reasons why I was late for airing the show. Now, he's a college student. I was telling him about student loans because I know a lot of us that go to college get student loans. Student loans usually give you about 4 to 6% interest rates on your student loans. And it's deferred until you get out of college. But some of them are no interest until you get out of college. Those are the subsidized loans. And some of them are unsubsidized, which are interest accruing until you get out of college. But your first payment isn't due until after you get out of college. Now, I told him, go and get all of it, because if you take it, I told you guys on the show, we have found some real estate investment trusts that's been around for decades now that are between 10 and 18%, almost 19% interest on those investments. Now, if you borrow money today, and one of the trusts that I looked into actually pays monthly. So right after you invest in it, every month after you invest in it, it's giving you back money. I told him, I said, look, they're deferring your payments until you get out of college. If you take the money, put it into the REIT, you're getting 18% interest off of the money. You take the dividends they give you every month, put it back into the REIT until you get out of college. When you get out of college, the amount of money they're going to tell you that you owe as a monthly payment is going to be paid off by the dividends from the REIT. You make your payment due date for your student loans 3 or 4 days after the deposit from the REIT and set up automatic bill pay. They're going to direct deposit money into your bank account. 3 or 4 days later, they're going to be taking some of the money out for your student loans. The change you keep. I tell them, don't worry about how much it costs when the cost of doing business is the profit that you make after the expense. As long as you're making more money than you're spending, it's the cost of doing business. So who cares if you have $100,000 of student loans, if you have a $100,000 portfolio that's paying you 18% interest and you're paying 6% interest back on that $100,000? Matter, because the other 12% or 14% interest, because I had to do the math there, 6 minus 18, yeah, so it's 12%. I had it right the first time. The other 12% interest that you're getting off of that $100,000 stock, that is profit in your pocket. Remember, I told you guys the story, the not even a story. I told you guys the platform where people use borrowing and lending to make money as an investment portfolio. This is one of the ways that you do it. If you borrow with low interest rates and then you invest that money into something with higher interest rates paid to you than the interest rate owed to the creditor that loaned it to you, the money that you're making off of the one asset is going to be higher than the money that you owe in the other asset. And that's where you turn a profit, where you are now making money off of somebody else's money without having to do anything else. Closest thing to passive income, next to just putting your money into a high investment yield account and just leaving it there and just letting them pay you royalties on a regular basis. Until they change the tax laws, because the gentleman I was talking to was in California, until they change the tax laws in the United States, as you pay for your student loan debt, it is a tax deduction. So the taxes that you would pay on the income earned from the dividends from the investment platform is going to be offset by the student loans that you're paying, which means that you're going to end up in a situation where you don't owe taxes if you did not make more money than you owe. There you go. We also have tax deductions in a lot of other areas, because if you have an LLC, whatever isn't written off on your personal taxes actually is written off on your LLC, where you actually get the benefit from combining all of this stuff to not owe as much to the U.S. government, which actually saves you, because remember, the Republican platform was for big business. So if you set yourself up as a moderate to big business, bro, you got all the tax brackets in your favor. Now, let's be real. Building a portfolio can be intimidating, especially for those who are new to investing. That's why I'm excited to share with you the journey that we're going to have of building a dream investment portfolio from scratch. Many investors need help to achieve their financial goals, and one of the biggest challenges is market volatility. We've all seen how quickly the market can fluctuate. When you've seen Bitcoin go up to $90,000, it isn't $90,000 right now, and make impulse decisions like buying into Bitcoin when it was at $90,000 and now it's less than $90,000. And based on short-term market trends, these temptations can really impact your decision-making skills, but you have to think rationally. After quarter four, most people who invested into Bitcoin is going to be pulling out in quarter one. So if you bought into quarter four at the maximum point of 90 grand, you're probably going to be taking a loss if you don't leave the money in there as a holding share, where you would only be getting paid 4% interest on your money. Another challenge is choosing the right assets for your portfolio. That's going to be something we're going to be talking about today. With so many options available, deciding which ones to include and how to allocate your investments can be overwhelming. And in addition to that, many investors are going to struggle with emotional decision making, such as fear and greed. Fear is going to be the fear to invest, and greed is going to be the failure to pull out early because you feel like you can gain just a little bit more, and then all of a sudden the market tanks when you could have pulled out beforehand. Now you're starting to take losses. You want to get in 20% before the bottom, because you don't want to miss the spike, and you want to get out 20% before, because you don't want to miss the drop. So if you can pull back in 70, 80% difference between the bottom and the top, you're good to go, because you turned a profit. And making those mistakes about trying to squeeze every little penny out of your investment can lead to costly mistakes. And finally, some investors may not have a clear investment strategy or goal, which can make it difficult to stay on track and achieve success. So steps to identify a high dividend, good performing stock is something that we're going to be talking about today, because the last time we talked about what high interest stocks they have. I talked about a lot of them that went anywhere between 4% and 18%, paying anywhere between annually and monthly. I went from regular stocks, brick and mortar stocks, to investment trusts all across the United States and some in Europe. So there are a lot of places that you can invest. I actually talked about over the past 2 weeks all of the different countries you could invest in and what industries would also give you incentives and benefits and tax deductions and write-offs. With all of those things that we've taken into account, I got to tell you right now, the first thing you have to understand is your dividend yields. So the definition of a dividend yield is the calculations as the annual dividend payment is divided by the stock price. And a higher yield indicates a more significant return on investment through dividends. Your target yield is going to be you looking for a stock with a dividend yield of 4% or higher, which is why I went through a list of all of the stocks that were 4% or higher, which is generally considered attractive. You're looking to evaluate dividend history and you want to see consistency. Check if the company has a high history of paying dividends consistently over the years and making sure that they're not taking losses. You're looking at companies that have raised their dividends annually for at least 5 to 10 years. These are going to be often referred to as dividend aristocrats. The stability is going to be another thing you're going to be looking for. In a volatile market, you're looking for some kind of stability. You want to look for companies that maintain or increase dividends even during economic downturns. So analyzing the financial health is going to first start with your earning stability. Ensure that companies has stable earnings that can support ongoing dividend payments. Analyze financial statements for revenue growth and profitability. Then double check the payout. You want to calculate the payout ratio, dividends paid divided by earnings. A lower payout ratio, generally below 60%, indicates that the company retains enough earnings for growth while paying dividends. You research industries and market positions are going to be other sectors of analysis. Some sectors like utilities, consumer staples, and a real estate investment trust, which I've gone deeply into, are known for higher dividend yields, and identifying companies within these sectors that have strong market positions is going to be very beneficial for you. Competitive advantages is going to be looking for the companies with a competitive edge, such as strong brand recognition like Tesla or Apple or T-Mobile, or unique product services such like Digitech or NASA or something like that. Use stocks screeners tools. These are going to be those fintech search engines that I told you guys about before. And you want to utilize stock screening tools available on financial websites. They have Yahoo Finance. I mean, Google's got one that's a lot better than Yahoo Finance. And then there's also Morningstar that you can also use to filter stocks based on dividends. If you were to take the time to tag stocks of interest in your Google platform, it will give you up-to-date real-time analysis of your stocks, of the stocks of interest, and show you when they're up and down, what the yields, payout ratios, and other financial metrics are. You can have this as an app on your cell phone. You can set these things up on your desktop. You can have it pop up in the background when you go into your search engine and start looking for stuff. All you really have to do is just customize your search engine. Reviewing analysis ratings and recommendations is going to be something that you really need to consider. The analyst ratings and census recommendations for potential stocks will inform you, actually, not just convince you, it'll inform you that stocks with a buy rating from multiple analysis may indicate a good investment opportunity. You want to monitor economic conditions, be aware of macroeconomic factors that can impact dividend paying stocks, such as interest rates and economic cycles. Higher interest rates can lead hire investors to favor bonds over high yield stocks. Because if you're looking at the deficit of the country, you might be able to buy into the deficit and get you a bunch of money when the country is down, but when the country is up, maybe not so much. You're looking at examples of high dividend stocks based on recent data. And some of these examples I'm going to be able to provide to you here today. And some of these are high dividend stocks worth considering. These are not the REITs that I was telling you about before, but you have Ultra Group MO that I told you about before that has dividend yields of 7.3% with annual dividends of $4.08 a share. You have Pfizer that I talked about before that's now at 6.8% with an annual dividend of $1.68 a share. Verizon that I've told you guys about, Verizon Communication, that has a dividend yield of 6.5% with an average dividend of $2.71 a share. Dow Incorporation that I've also mentioned before has 6.4% at a $2.80 a share dividend annually. You have Ford Motor Company that is 5.5%, which is combative of Dodge, and there is an annual dividend of 60 cents a share. And Conagra Brands, CAG, is going to be giving you a 5.2% yield with an average dividend of $1.40 a share annually. And Realty Income Corp, which is known for monthly dividends consistently increasing over time. And that's going to be something that you're really going to love. And when it comes to investing, if you have this knowledge and power without clear understanding of different asset classes and how they work, it's easy to get caught off guard by market ups and market downs. As I've learned, it's essential to educate yourself on the various investment options available, including stocks, bonds, real estate, and more. By understanding the potential benefits and risks of each asset class, you can make informative decisions about your portfolio and avoid costly mistakes. When I first started investing, I was overwhelmed by the sheer number of options available. I felt like I needed a PhD in finance just to make sense of it all. But as I dug deeper, I realized that investing doesn't have to be complicated. By focusing on the core principles of investing, such as diversification, risk management, and long-term thinking, I was able to create a portfolio that aligns with many financial goals and risk tolerances. Stocks, for example, offer potential for high returns over a long term, but they can be volatile in the short term. Bonds, on the other hand, provide a relatively stable source of income, but may not offer the same level of returns as stocks. Real estate investing can provide a hedge against inflation and diversify your portfolio, but it requires a significant amount of capital and expertise. By understanding the unique characteristics of each asset class, you can create a balanced portfolio that meets your investment goals and risks tolerance. As I explored the different asset classes, I realized that there's no one-size-fits-all approach to investing. What works for one person may not work for another, and that's why it's essential to create a personalized investment strategy that aligns with your unique financial goals and risk tolerances. By doing so, you can create a portfolio that's tailored to your needs and helps you achieve financial success. So, what's the secret to building a dream investment portfolio in 2025? For me, it's all about creating a balanced portfolio that is diversified across different asset classes and risks levels. By allocating my investments wisely and managing risks, I can create a portfolio that is resilient to market ups and downs and align with my long-term financial goals. By focusing on core principles of investing and staying disciplined, I can avoid costly mistakes and stay on track to achieve financial freedom. One of the other things that I wanted to talk to you guys about is real quick, you're going to love this part. The fact that if you're starting out, you're only going to have one stock option, one stock idea. And because you're only going to have one stock idea when you first start out, you're going to start off in one sector, whether it is getting a TD Ameritrade account and buying a bunch of shares, buying a bunch of options to get you some stocks going under your belt, or if you're going to find a way to get involved with some REITs and invest in some real estate investment trust, or if you're going to start buying into gold and silver, you're going to start somewhere. But as you make the profits off of the shares of those stocks, I would recommend that you start off with something like a real estate investment trust that's going to be paying you monthly dividends. Because after you build up a certain quantity of capital in that real estate investment trust, you would be able to then take the interest off of the dividends paid to you and give that to another investment platform. So your principal is right here in the investment trust. And then after that, the profits that come off of the investment trust is put into something that is more risque. So now you could take money out of real estate, put it into regular stocks and bonds. You could take some money out of the profits from the stocks and bonds and put it into government bonds and index 500s. You could take the profits from all of those and throw that into Bitcoin. Then the volatility of Bitcoin is not going to negatively impact you because you have a guaranteed streamline of cash where Bitcoin is the icing on the cake. You can start with Bitcoin, but if you take a massive loss, you take a massive loss. You don't even have a principal to start over with. If you have a principal that is guaranteedly paying you interest from a dividend yielding an interest yielding dividend based account, then you would be able to take that capital when you get your next month's installments, next year's deposits, go back in there and try a second time. And you would be able to watch the market trends, watch the rises and falls. And this time when you invest, you want to invest early when the market is down, and then you want to pull out early before the market peaks off. That way you walk away with something instead of trying to get everything on the table. Everybody's got to eat. In investments, somebody has to make a bad decision and lose money in order for somebody else to gain money. So in order for you not to be the person that loses money, one of the things you have to think about is managing when you want to buy in, when the stock is at its lowest or the investment platform is at its lowest, and then know when you want to pull out. If you're not trying to be a day trader where you're sitting there every day for a few hours buying and selling stocks, if you're not going to be sitting there every 4 hours micromanaging your bot trading, you want to make sure that you put your money somewhere where you can count on it to grow. When you decide to start day trading, where you're going to spend 2 to 4 hours in the morning when as soon as you wake up and move your stocks around, make your trades for the day, and then walk away, you still got to build the habit of checking those trades every day, checking the economy every day, start paying attention to news every day, because the stuff that happens in not the crime and everything like that, but when crime, sometimes when crime happens, like if a jewelry store gets robbed, that jewelry store is going to take a negative impact in the stock market. When a building burns down, like in that riot in Tampa, Florida in 2019, when they burned down that Champs, the fact is that store took a massive hit, and that massive hit negatively impacted the investors. So certain things that you have to pay attention to in your day-to-day operations that then helps you steer the direction of how would that affect the market. There's two ways that it's going to affect the market. Either the society is going to be pissed off at the company and stop buying stuff from the company, or the company took a hit and now the company's taking a loss. And because the company's taking a loss, the investors will take a loss. When the investors take a loss, some investors start selling. When those investors start selling, that triggers a lot of other people to start selling. That, depending on how many people sells, depends on how far the stock will drop before people start buying it. See what I'm saying? So you got to pay attention to these particular types of factors, because nobody actually talks about this stuff. So if you're paying attention to the natural rises and falls in the stock market season to season, the annual changes, which is why I told you earlier, 5 to 10 year changes, you're able to see consistency in volatility. And when you see consistency in volatility, you capitalize on the volatility. When the market is down, you buy in. When the market is high, you cash out. You can understand that the market normally peaks at a certain level and cash out, and then there's a massive spike that you didn't anticipate. That's perfectly fine. You might have not have got the unexpected spike, but guess what? If you would have been hoping for that unexpected spike and then it took a massive decline on schedule, you would have taken a massive loss because you were waiting for a increase that didn't occur. So you just gotta pay attention to when you're buying in and when you're cashing out. As you pay attention to, even if you just come over the hurdle of the peak and it starts to go back down, before it goes back down too much, you want to sell off. Be one of the ones that sold off slightly late, just so that you don't lose everything that you put into with the scenario. And that's some of the things, like stock market can change overnight while you're sleeping. And that's something that's going to be very detrimental to you. And since the stock market can change on you while you're sleeping, you want to make sure that you are keeping track of what you're investing in during the day, and then also take a look at some stuff before you go to bed. That's one of the reasons why some of the most successful people in this country are up at 4 or 5 o'clock in the morning. It's 1, 2 o'clock in the morning. You're able to look at your money right now and see what's good and what's bad, what's beneficial, what's not beneficial. And that will help you find ways to make yourself more financially successful, because as soon as the market opens, if you're scheduling trades to be done while you're asleep, because New York is going to start making moves before California rolls out of bed. New York is going to be having lunch when California wakes up. You do not want New York to make all of the best moves before you wake up in the morning. You want to set those best moves before you go to bed, so that when you wake up in the morning, all of the moves that could have been made were already pre-scheduled, already set up, already moving around while you're sleeping. That way you're making money in your sleep. It is a form of residual income, because you do have to put effort into making sure that your money moves where it needs to move to. But I can definitely guarantee you that you're going to make, because you're micromanaging your portfolio, you're going to make a little bit more revenue off of your stock trading than what you would make if you just threw it up there and left it there and see what happens. But you will have even an automated dividend percentage yield if you just threw the money up in there and left it alone, if you watch certain companies that are always on a steady incline. So you want to make sure that you do what it takes to keep track of all of the stuff that you need to have for proper record keeping of these stocks and bonds and mutualities. So with that being said, because I wanted to go through this, but I know that this is a very short topic, because this is a follow-up from a previous show. So because of that, I wanted to make sure that you understand that you can build a dream investment portfolio going into 2025. And this is going to require your solid understanding of different asset classes and clear investment strategies and disciplined approach to managing risk, which also means that you're going to have to start trying to work your way from living at a 99% of your income lifestyle to trying to live at a 50% of your income lifestyle, so that you can have 50% of your expenses being paid by your money, and the other 50% of your expenses being divided up between 30% in stocks and 20% of entertainment, or 45% of your stocks, and maybe 10%, 5% towards entertainment, where you are putting the majority of the money that you're not spending on bills on investment portfolios, which will make you more financially successful. Also, remember that you're not wasting your money on anything that is a luxury if you don't have. What's going on, Rudimus? Good to see you, brother. I'm starting mad late. I had to get in here because I didn't do the show. I actually have the wrong title even up here. I got to do all the editing after I finish with the show, get all of the information moved over so that I can run today's real topic tonight on time at it's going to be 10 o'clock Eastern, 9 Central, and 6 Pacific. I should be running it on time. It's always good to see you. It's always a pleasure. Always a pleasure, man. You know, I know you be up here all hours of the night, or is it morning for you where you're at? So while he's getting that in there, I wanted you guys to know that if you are focusing on redirecting your assets so that you have a lot of money to save up to invest towards things, and then you're only buying a luxury when you have the ability to afford 3 to 10 of that item. So you want $100,000 car, you're not going to buy $100,000 car unless you have accessibility to the quantity of money to buy 3 of that car or 10 of that car. Then you go and buy 1 of that car. Why would you do that? Well, because the taxes on the income that requires to make $100,000, roughly 10%, which is 10 $100,000 cars. You are able to buy that car as a business expense, which then gets written off as a tax write-off, 100% on the first year when you first buy the car, which then takes that 10% off of the $100,000, the $1 million that you made off of that year, and that would offset your debt. Now, 30% is somewhat the same thing. If you're doing it when you have 1/3, which is 33%, if you're dealing with taxation at 35%, if the car costs 30% of your income or 30% of your profits, 30% of your taxable income, I'm saying it the same way every time. I'm not stuttering. 30% of your income, 30% of your profits, 30% of your taxable income, you got to think about the fact that if you're taxed 35%, if 35% of your profit is the value of the car, or 30% of your profit or 33% of the profit is the value of the car, when you start calculating all of the other things in your overhead into deductions, guess what? The car turns out to be free in comparison to the amount of taxes you would have owed anyway on the money that you made. These are the things that people don't pay attention to, they don't think about, they don't talk about. So by focusing on these core principles, you can create a portfolio that helps you achieve financial security and financial freedom. So before I walk out of here today, because today was going to be a short one, I wanted to thank you guys for joining me on this small journey to add extra emphasis on last week's episode when we was talking about how to invest in stocks, bonds, and mutualities. And now we're talking about ways to analyze the dividends and ways to analyze a good stock platform where you can build you a really good, successful portfolio. And this is going to help you start from scratch in 2024 going into 2025, because we only got about 20 days left of, not even, we got like 18 days left of 2024. And then we're going to be into the full Republican capitalist model. If y'all aren't paying attention to what I'm saying, I don't know what to tell you, because as I become successful giving you this advice, you're going to be looking at me like, damn, he made it. And he was telling me how to do it the whole way. Robinhood gave me the master passcode to the safe, and I didn't go in there and get me a cut. I don't know what to say. After this 4 years, if you still broke and struggling, you did that to yourself. That's the only thing I can tell you. So if you're working on building your own portfolio, I'd love to hear about your strategies in the comments below. And if you're new here, be sure to check out some of my videos, because I got some coming up that are going to be financial tips. We're going to have some insights. We're going to have relationship topics. We're going to have social interaction topics. And we're going to have a lot of other topics outside of these topics, because we also have the band that made Higher Ground, which is the new official theme song for This and That. You're going to be hearing another variation of Higher Ground, which is actually the outro for This and That theme song. And we also have another one, which is almost like a WrestleMania intro theme music. It's really, really awesome. They got like 4 tracks for the podcast. So we're going to try to get the artists up onto the show. We're going to be scheduling that coming soon. And then after we finish getting all that worked out, you guys will be able to see a really awesome intro and outro for the show before we get into business. So I want you guys to just really take your time to hang out after the show and see how the show progresses, if you feel like it. And if you don't, then I'm going to see you tomorrow, or not tomorrow, later today, because it's 2 a.m. on Thursday. So tonight at about 10 Eastern, 9 Central, 5 Pacific, we should be teeing off. I actually might decide to run it at 10, but I really feel like I'm going to try to start it at 9 Central so that we can go ahead and spend a few hours ironing things out today. So until we meet tomorrow, I wanted to tell you guys I really appreciate your time coming to the podcast tonight so that we can kind of iron out all the details. Ladies, as long as the situation doesn't make sense, I'm going to keep asking y'all to make it make sense. So, ladies, please make it make sense. Fellas, I really appreciate you coming. A special shout out to Rudimus, Reese, Max, Omni81, Red Void, Silly Emma, Liberty Twitcher. We've got a whole list of everybody that has been showing us a lot of love on the show as of late. And we really appreciate you guys coming to the podcast. Remember, we are going to air every night of the week. So just keep your eyes out for it, because whenever we start, we're going to tee off and we're going to try to give you a reasonable quantity of time for a show. Usually we try to give you a full hour, but, I'm doing a follow-up. So there isn't a full hour worth of follow-up. There's only like 30, 40 minutes worth of follow-up. And I don't like wasting you guys' time. So with that being said, I'm going to tell you guys, thank you for coming to This and That on tonight's show, where we're talking about this, that, and everything in between. I hope you guys enjoyed a song after the show that was customly made for the podcast. So beyond that, I'm going to see you guys in about 12 hours. Well, 16 hours, something like that. But see you guys later today. I'm your host, Xander, for This and That, where we talk about this, that, and everything in between. And y'all have a good morning.